Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something.
Hello and welcome to today's lesson. Today we look at financial statements and in particular revenues, costs and profits of businesses. So today this is what we need to achieve. We need to understand how a business makes a profit and then calculate the profit or loss, heaven forbid, for a particular period. We start off with stock or inventory. Now, what is inventory? These are goods that are purchased by the business for the purpose of resale, and it can also be called stock or merchandise goods. So a business will have goods that are purchased with the intention of being sold again after some value has hopefully been added to the product. So this particular business, the inventory t-shirts have been bought in at $3 and they are sold at $7. Now inventory is recorded at the lower of cost and net realizable value. So in this case inventory is $3, not $7. The net realizable value, that is a term that describes the value of an asset that can be realized upon the sale of the asset. So inventory is an asset. In this case, these t-shirts they're valued at $7 because that's the realized value once those t-shirts are sold. At least once a year, a physical stock take is carried out to find out the correct amount of stock on hand, because stock changes each during the period. And here the stock is going to be recorded at the lower of the cost and net realizable value. So in this case, even though the t-shirt has had some work done on it and it's ready for the shops at $7, it'll be recorded in the inventory as $3. Profit, how do we make it? How does a business make it? We'll stay with our t-shirt example, our t-shirt business. Cost price is the price at which goods have been bought by the merchant or the retailer. And the cost of goods sold, this is the cost of goods sold being the accumulated total of all costs used to create a product which has been sold. Now, costs typically fall into the general categories of direct labour, materials and overheads. There will be a markup on the components that are bought in and used for production. In this case, t-shirts are bought in at $3, some work's done to them, some printing, and there's a markup of $4 because they're being sold at $7. So we say that's a markup of 133.33%. But of course they're not just the costs of those components that are bought in. There's business expenses such as rent, electricity, repairs and maintenance, wages of the staff and transport of the good. And these are called overheads. Now overhead expenses are all costs on the income statement except for direct labour, direct materials and direct expenses. Overhead expenses include accounting fees, advertising, insurance, interest, legal fees, labour, rent, repairs, supplies, taxes, telephone bills, travel expenditures and utilities. And that's not an exhaustive list. Now, if the owner of the business is to make a profit, they need to sell their goods, which is called sales income, at a higher price than what they bought them for. So the selling price must be greater than the cost price. Cost price is usually called cost of goods sold. Cost of goods sold. Now these consist of any expenses that are incurred in getting the goods into the location and condition where they can be sold. Key definition. So when a trading business buys goods, our inventory, to sell, we call this purchases. Now sometimes a business may return goods to the supplier, and we've hit this already. This is called purchases returns. Purchases returns is going to reduce the cost of goods sold because that money is in effect refunded, reducing the amount the business is spending on purchases. Customs duty. Now this is paid when goods are imported from overseas. So if those t-shirts are made in Bangladesh, they're shipped to New Zealand, there's going to be a customs duty. Now that duty must be paid before the customs department is going to release the goods into the hands of the purchaser, the business. Cartage, or freight inwards, is payable in order to get the goods to the location of sale. So this is also part of cost of goods sold. Cartage is a term used to describe the cost of local delivery. So for example, the railway station to the warehouse. Freight is a term used to describe long distance carriage, so such as between different cities or overseas locations. Packaging materials are sometimes used where a trader buys bulk supplies and then packages them into smaller amounts. Now a good example of this may be a supermarket which purchases a large quantity of rice and then later repackages this rice into small sellable packets. Net sales. Sometimes a customer may return a good. It doesn't fit, there's something wrong with it, there's a defect, or they're just not happy with it. Now this is called sales returns. Sales returns are deducted from sales to find net sales. So 4 t-shirts have been sold at $28. That's income, sales. However, there's one unsatisfied customer who brings her t-shirt back. So one of those t-shirts, sales returns, net sales would be $21. Gross profit and the trading statement. Now gross profit, a company's total revenue, which is equivalent to total net sales, less the cost of goods sold. So gross profit is the profit a company makes after deducting the costs associated with making and selling its products or the costs associated with providing the services that it provides. So for example, sales of 100,000, sales returns 5,000, that must be net sales of 95,000. From that, the cost of goods sold is subtracted, determining the firm's gross profit. Sales less sales returns equals net sales. Net sales less cost of goods sold will give the firm's gross profit. Inventory. Just a technical note here. We are going to be using a perpetual inventory system to prepare our financial statements. Perpetual meaning this is continuous, it's ongoing, it's regularly updated. So records of stock movements are kept throughout the accounting period. And that means that the balance of stock on hand is continually updated throughout that period. New t-shirts come in, inventory is updated. T-shirts are sold, inventory is updated. In the perpetual inventory system, the inventory account is going to be adjusted when the business buys or sells inventory. A ledger account for cost of goods sold is also going to be used, so this is reported as one figure in the income statement. Right, so we have some transactions here. We've got a purchase of stock inventory for cash. Is that a debit? We're going to debit inventory. And GST, of course. Credit bank. We're going to credit bank with the cost price. Transaction, this time the stock is purchased on credit. What are we going to debit? We're going to debit inventory again with our GST. Credit accounts payable, and that credit will be with the cost price. Cash sales, what are we going to debit? Cost of goods sold, credit, inventory, and again with the cost price. And as we have been doing, we're going to debit bank and credit sales with GST as well. And this is all done with the selling price. Transaction, credit sales. We're going to debit the cost of goods sold, credit inventory with the cost price, debit accounts receivable, credit sales with the GST as well. And again, this is all done with the selling price. So you can see we're making adjustments to the inventory, and it's factored into the cost of goods sold, and we're also doing those other transactions that we have been doing previous to this.